Okay, let's actually play a little game to start things off. I want you to just close your eyes and picture the fast casual dining landscape.
Okay.
But not today. We're going to rewind the clock a bit to late 2024. You're walking down the street in New York or maybe LA. You pass a Sweetgreen. What do you see?
Well, you see a line out the door, usually. You see people holding those hexagonal balls, like they're basically status symbols.
Right.
And the stock ticker, SG, I mean, it was the absolute darling of everyone's portfolio.
Yeah, it really felt like they just couldn't lose. The tech was flashy. The salads were, culturally relevant. Investors were thrilled. It was like the apple of salads. But now open your eyes. It is today, March 1st, 2026. And the picture has, it has completely changed.
Yeah, changed is putting it pretty mildly. It's a completely different reality now. The narrative hasn't just shifted. It's been flipped upside down and shaken for loose change.
Truly. We are looking at a reversal of fortune that is honestly just hard to comprehend if you haven't been watching it day by day. I mean, the stock is down 87% from its peak in late 2024.
It's a staggering number. Nearly 90% value destruction in just over a year.
Yeah, just to put a really fine point on it for everyone listening, the stock was trading at a high of $27.15 about a year ago today.
Yeah.
As we sit here recording this deep dive,
Yep.
it is hovering around $5.54.
It's a collapse. I mean, it is a full-blown correction.
So the mission for this deep dive is pretty clear. We've got a massive stack of documents here. We are pulling from the Q4 2025 financial reports, their investor guidance for 2026, and a bunch of recent announcements regarding menu changes and asset sales.
Right, the whole kitchen sink.
Exactly. And we need to unpack how a fast casual darling lost its way so quickly.
And perhaps more importantly, we need to analyze their new back-to-basics strategy, because they are essentially betting the entire farm on a very specific, very humble menu item.
Right. Can a chicken Caesar wrap save a company that spent years trying to be a tech giant?
It sounds almost ridiculous when you say it out loud like that. From infinite kitchens and robots to a tortilla.
We're definitely going to get to the tortilla, I promise. But first, we have to eat our vegetables. Or in this case, the numbers.
Always the numbers.
Yeah, I was reading through the Q4 2025 report you sent over, and I kept thinking there was a typo. Calling it a disastrous 2025 feels like an understatement. What exactly happened to close out the year?
Well, it wasn't just one leak in the boat. It was everything moving in the wrong direction all at once. The headline number that Wall Street completely panicked over was comparable sales. In Q4 of 2025, they declined by 11.5%.
Okay, let's pause there for a second. Comparable sales. We hear this term a lot in retail. Let's unpack that for a second. Why is this specific number the one that matters so much?
Sure. So comparable sales, or comps as we usually call them, measures the revenue generated by locations that have been open for at least a year. It strips out all the noise of new store openings. Because, if your total revenue goes up just because you built 50 new stores, that doesn't actually mean your core business is healthy.
It just means you spent money to open doors.
Exactly. Comps tell you if your existing customers are actually coming back.
So if comps are down, it means the actual popularity of the brand is shrinking.
Yes. And down 11.5% it's catastrophic. In the restaurant industry, you start getting nervous at -2%.
Right.
You start firing executives at -5%. At -11.5%, you are fundamentally questioning the viability of the entire business model.
Wow. Okay, so the core business is just shrinking rapidly.
And the broader revenue numbers followed suit. Revenue fell 3.5% to $155.2 million. They missed estimates on both the top and bottom lines.
It's just wild because, and I really want to remind everyone listening of this, 2024 was great.
That is what makes the whiplash so severe here. In 2024, comparable sales were actually up 6%. They had positive adjusted EBITDA of $18.7 million.
EBITDA. Another acronym we should probably clarify really quickly.
Right. Earnings before interest, taxes, depreciation, and amortization. Basically, it's a standard measure of a company's operating profitability.
Like, are you actually making money on the day-to-day operations of the business?
Exactly. And in 2024, they finally turned that corner. Everyone looked at it and said, okay, Sweetgreen works. The growth machine is officially on.
And then 2025 hits, and it's like the floor just completely fell out from under them.
It wasn't a slow decline. It was a cliff.
Yeah.
And here's the scary part. The guidance for 2026 isn't offering much hope for a quick bounce back either.
What are they projecting?
They're projecting comparable sales to drop another 2 to 4%.
So the bleeding hasn't even stopped.
Not yet. And margins are getting squeezed heavily, too. They're looking at restaurant-level profit margins compressing to roughly 14.2 to 14.7%.
Is 14% good? Bad. I feel like I've seen companies like Chipotle post numbers way higher than that.
You absolutely have. A healthy, efficient, fast casual chain like Chipotle aims for margins in the mid to high 20s.
Okay, wow.
Yeah, Sweetgreen investors want to see that number climbing toward 20% at least. When you drop down to 14%, you are barely covering the cost of the food and the labor required to make it.
Right, there's nothing left.
There's very little left over to pay for corporate overhead or marketing or your incredibly expensive real estate.
So naturally, the big question is why? Was this just bad luck? Did the world fundamentally change, or did Sweetgreen make active mistakes?
It is rarely just one or the other. In this case, it is a really fascinating, if painful, mix of external headwinds, which is the bad luck, and self-inflicted wounds, bad judgment.
Let's start with the stuff they couldn't control. The acts of God, so to speak.
Well, you have to look at geography first. Sweetgreen has a massive, massive footprint in Los Angeles. And in Q1 of 2025, the wildfires in LA caused a really significant setback.
Oh, right, I remember seeing the news on that. Stores closed, smoke everywhere, people just staying inside for weeks.
Exactly. That hurts operations, it shuts down stores, it keeps your core demographic at home. That started the year off on a terrible foot.
And you can't blame the CEO for wildfires.
No, you really can't. But fires eventually go out, the smoke clears, the sales didn't come back.
And that brings us to the broader economic picture. We have talked about this in other deep dives, the young consumer problem, the discretionary spending just drying up.
The vibe session turning into a very real recession for people under 30.
Precisely. The younger demographic, millennials and Gen Z, they are Sweetgreen's bread and butter. And they just stop spending as freely. Now, Sweetgreen management will tell you, hey, look at our competitors. Chipotle, Cava, they're seeing sales growth evaporate too.
And that's true, right? We've seen those headlines across the sector.
It is true, but Cava isn't down 87% in the stock market.
Right. Good point. Sweetgreen's full-year same-store sales were down 7.9%. That is significantly worse than its peers. So yes, the tide went out for everyone, but Sweetgreen was standing the furthest out in the water without a swimsuit.
Which points directly to the internal missteps. What did they do wrong inside the house?
There are two main things that stand out in the analysis of 2025. First, the loyalty program.
Oh, the stuff from SweetPass Plus.
Yes. In Q2 of 2025, they abruptly switched from the SweetPass Plus subscription model to a much more traditional loyalty program.
I remember the subscription. It felt very tech. You pay a monthly fee, you get daily perks. It felt a bit like Amazon Prime for salads.
And that's exactly why it worked, psychologically speaking. It locked people in. If you pay for the subscription upfront, you feel obligated to go to Sweetgreen to get your money's worth. It creates a deeply ingrained habit.
So why on earth would they kill it?
Most likely because it was incredibly expensive to maintain. Or they thought they could get the exact same loyalty without giving away as much margin on every order. But they shifted to a standard points-based system. Spend dollars, get stars, right when the economy tightened up.
Bad timing.
Terrible timing. They introduced friction right when customers were actively looking for an excuse to cut back. They lost all those locked-in members overnight.
It's like breaking up with your biggest fans.
Right.
But the bigger issue, and the one I see absolutely everywhere on online forums, is the price itself.
Value perception. This is the killer. This is the whole ball game.
I mean, let's be real for a second. A custom bowl with steak and avocado, in some cities, you were pushing $18, maybe $19.
Exactly. And in an economy where young people are heavily tightening their belts, there is a very real psychological ceiling. We call it lunchflation fatigue.
Lunchflation fatigue, I like that.
At $14 or $15, you might grumble, but you pull out your card and pay. At $18 or $19, it crosses a line. It starts to feel like a luxury purchase. It's the very first thing you cut from your weekly budget.
And the data shows this hit them much harder than a place like Cava.
Much harder. Cava has a slightly different value proposition. It feels heavier, more filling. You're getting rice, dips, falafel. A salad, rightly or wrongly, is often perceived as light. Paying almost $20 for light food when you're broke is a very tough sell.
So you're bleeding cash, sales are completely down, and your core customers think you're a ripoff. What do? Apparently you start selling the furniture, or in this case, you sell the robots.
This was the surprise news from November 2025. They announced the sale of Spice.
Now, for anyone who doesn't remember the hype cycle from a few years ago, remind us what Spice actually was.
Spice was a robotics company that Sweetgreen acquired. They made the Infinite Kitchen. It was this incredible robotic stir-fry machine, essentially a fully automated make line.
I remember the promotional videos.
Yeah.
The bowl spinning down the line, ingredients dropping in perfectly. It really looked like the future of dining.
It was the absolute centerpiece of their corporate narrative. They told Wall Street, we aren't just a restaurant chain, we are a tech company. And that narrative is what justifies a massive tech-like stock price.
And they just sold it.
They sold the business unit itself, yes. Now, this is a very crucial distinction in the filings. Sweetgreen retained the rights to use the Infinite Kitchen technology in their restaurants.
Oh, okay.
So you might still see the actual machines in some stores, but they no longer own the business that is developing it. They don't own the patents, and they don't have that expensive R&D team on payroll anymore.
So putting on your analyst hat for a second, when you see a company sell off its crown jewel tech unit, what does that signal to the market?
Distress. Plain and simple. You do not sell your proprietary tech unit, the very thing that was supposed to give you a massive competitive moat, unless you desperately need cash.
It's a liquidity event.
Exactly. It's a move designed entirely to shore up the balance sheet. Developing robots is incredibly expensive. It requires massive capital expenditure, or CapEx. By selling Spice, they are drastically cutting their cash burn rate.
But isn't it also sort of admitting defeat on their grand vision?
In a way, absolutely yes. It is a full retreat back to the core business. They are basically saying to the market, we can't afford to be an R&D lab anymore. We just need to sell food.
Which brings us nicely to the present day and the so-called light at the end of the tunnel, or at least what Jonathan Neiman hopes is the light. If the high-tech bowls aren't selling, what is the survival plan?
The plan is wraps.
Wraps.
Wrap.
It feels so, I don't know, to 2005.
Yeah.
It feels like something a consulting firm came up with in a blind panic.
It does feel a bit retro, doesn't it?
Yeah.
But if you actually look at the strategy behind it, it makes a lot of sense. They are testing these right now in New York, the Midwest, and Los Angeles. And it is really the first major entree expansion beyond bowls in the entire company's history.
What are the flavors? Because if we're talking about kale and quinoa wraps, I don't see how that moves the needle.
No, and that's the key here. The launch lineup is designed to be very, very approachable, almost diner style.
Okay.
You have the classic chicken Caesar, a chicken jalapeno ranch, and a chicken salad bacon club.
A chicken salad bacon club.
Yeah.
That does not sound anything like the Sweetgreen of 2024.
It doesn't. Notice the ingredients they're highlighting. Bacon, ranch, Caesar dressing. These are pure comfort triggers. They are aggressively moving away from that purely health-obsessed, zero-calorie image to something much more savory and satisfying.
It sounds like they're literally just trying to be normal.
They are trying to be broadly appealing to a mainstream audience. But the real strategy here isn't just the flavor profiles, right? It's the underlying math.
Okay, break down the wrap math for me. How does this fix the balance sheet?
This connects directly back to that value perception problem we talked about. The pricing strategy for the wraps is incredibly aggressive. They start at $10.95.
$11. That is massively cheaper than the custom bowls.
Significantly cheaper. And they're promising to stay under $15 at all locations, even in high-cost cities like New York. This is a direct, calculated attempt to create a new entry-level price point.
Because right now, if I have $12 in my pocket for lunch, I literally cannot eat at a Sweetgreen. I can't even get in the door.
Exactly. You walk right past it and you go to Taco Bell or McDonald's. The wrap is a bridge. It's an attempt to win back those exact customers who walked away because they felt completely priced out of the $17 bowls.
But wait, isn't there a massive danger here? We talk about this in retail deep dives all the time, the threat of cannibalization.
It is a huge risk. It is the biggest risk of this entire rollout.
Because if I usually buy a $17 bowl, right?
Yeah.
And I walk in and see an $11 wrap that sounds delicious, and I switch to the wrap some, Sweetgreen just lost $6 of revenue from their best customer.
Correct. That is the absolute nightmare scenario for their CFO right now. You trade down your existing, reliable, high-value customers. For this wrap strategy to work, it can't just convert the existing base.
Right.
It has to drive massive new foot traffic. It has to bring in people who weren't coming at all over the last year.
It's a pure volume over margin play.
Yes. They need to sell a whole lot more units to make up for the significantly lower price tag. CEO Jonathan Neiman is pinning essentially the company's future on this. He has publicly called menu innovation the key to their 2026 transformation. If these limited market tests go well, and to be fair, early reviews on social media are quite positive, a wider nationwide rollout is planned for mid-2026.
So the summer of 2026 could literally be the summer of the wrap.
That is the bet they are making with their remaining chips.
Okay, so let's pivot to the listener who might be looking at their brokerage account right now.
Yeah.
The stock is at $5.54. It used to be $27. Is this a fire sale? Is it time to be greedy when others are fearful, as the old Buffett saying goes?
That is the million-dollar question. Or I guess maybe the $5 question today.
Fair enough.
It is a classic falling knife scenario in the market. There is a very distinct bull case and a bear case here, and frankly, they are both pretty compelling depending on how you look at the data.
Well, give me the bull case first. Give me the optimism. Why would anyone hit the buy button on this stock right now?
The optimism is purely about valuation relative to brand strength. The stock is currently trading at a price-to-sales ratio of just 1.
Unpack that for the non-investor listening. A price-to-sales ratio of 1.
It means the total market value of the entire company is equal to just one single year of its revenue. For a high-growth restaurant chain, you usually see ratios of 3, 4, or even 5. A ratio of 1 suggests the market thinks the company is fundamentally broken and will never grow again.
So it's priced for absolute failure.
Yes. But look at the historical unit economics. Sweetgreen had very high average unit volumes. They were doing around $2.9 million per store before this 2025 decline.
Meaning the physical box itself works. People actually like the food when they can afford it.
Precisely. The brand has real, tangible equity. The fundamental concept of fast, healthy food isn't dead. If the macro climate improves, if young people get a bit more disposable income and start spending again, and if these wraps successfully fix the value perception issue, there is a lot of room for the stock to bounce back.
Right.
It doesn't have to go all the way back to $27 to be a huge win for an investor today. If it just goes back to $10, you've nearly doubled your money.
Okay, that sounds extremely tempting. Now, ruin it for me. What's the bear case? Why stay away?
The bear case is hidden in the operational financials, specifically the gross margin. It is currently sitting at a terrifyingly low 4.71%.
Ouch, under 5%.
It is razor thin.
Explain why that's so incredibly dangerous for a restaurant.
Gross margin is what you have left over after paying for the direct costs of making your product, the food, and the packaging. If your gross margin is 4%, you have almost absolutely no buffer against reality. If the wholesale price of avocados goes up due to a supply chain hiccup, you're losing money on every bowl. If local labor costs rise even slightly, you're losing money. If sales drop just a tiny bit more than expected, you are entirely underwater.
So they have zero wiggle room for error.
Zero. And remember, their own guidance for 2026 forecasts another tough year with sales continuing to drop. The bear case argues that they are already in a death spiral.
The death spiral, that's a strong term.
It is, but it fits the mechanics. You cut costs to survive, so the food quality or store cleanliness drops, the quality drops, so more customers leave, sales drop further, so you have to cut costs even more. It is incredibly hard for any management team to pull out of that specific dive.
So what's the ultimate verdict here?
It is a high-risk play. This isn't a safe, steady bet for your retirement fund. This is a gamble. You are essentially betting that Jonathan Neiman and his team can pull off a miraculous turnaround with a chicken Caesar wrap before the corporate cash runs out entirely.
It really is wild when you frame it exactly that way.
It is a stark reality.
So let's quickly recap this whole journey. We had a completely disastrous 2025, where Sweetgreen lost 87% of its market value.
Driven by a perfect storm of LA wildfires, a massive pullback in youth discretionary spending, and a very botched transition away from their locked-in subscription model.
Correct. And now, just to survive 2026, they have sold off their futuristic automation unit Spice just to raise cash. They are openly admitting the tech company dream is over, at least for now.
And they are pivoting hard to a lower-priced, much more traditional menu item, the wrap, to try and urgently fix their reputation for being way too expensive.
And for the investor looking at this, the stock is definitely cheap, but cheap doesn't always mean good.
Exactly. It's cheap for a very valid reason. Unless they fix the fundamental business problem, which is simply that people do not feel they're getting enough value for their hard-earned money, the stock price won't matter because the company might not even exist in its current form a few years from now.
It's a really sobering story, honestly. It reminds you how brutally fast things can change in the restaurant world. You can be the king of the hill one year, on the cover of magazines and fighting for your life the very next.
It moves incredibly fast. In retail and dining, you are truly only as good as your last quarter.
You know, before we wrap this up, no pun intended,
Yeah.
there was one final thought I just can't shake after looking at all these sources.
What's that?
Sweetgreen spent years and millions upon millions of dollars trying to convince all of us that they were a tech company. You know, infinite kitchens, SweetPass Plus, data-driven supply chains. It was all very Silicon Valley. It was sleek. It was algorithmic. It was pitched to VC firms.
It was a massive part of their allure. It's entirely why they commanded those high tech-like valuations in the first place instead of being priced like a normal salad shop.
Right. But now, when their back is completely against the wall, when it is literally life or death for the brand, what is saving them? What is the master plan? A chicken Caesar wrap, a tortilla, bacon and ranch dressing.
It is deeply ironic.
It just raises this huge question for me, and I think it's something for everyone listening to ponder. In the restaurant business, is all that innovation sometimes just a massive distraction? We get so obsessed with the app interface, the robots, the customer data harvesting. But maybe at the end of the day, you really don't need an algorithm. You just need to serve good, tasty food at a price that normal people can actually afford.
That is the ultimate lesson here, I think. Technology is a great enabler, but it doesn't taste like anything. You cannot eat code. When times get tough, value and flavor will always win out over a spinning robot.
Something to chew on next time you grab lunch. Thanks for joining us for this deep dive into the Sweetgreen correction. We'll catch you on the next one.
Take care, everyone.